How to select an investment advisor. First off, I am not an advisor. I'm not trying to sell you anything. I'm a whistleblower. I post these videos to help protect people from rip-offs. Also, after you watch this video, be sure to watch my other related videos called How to Invest Your Money and Mutual Funds Explained by Index Funds. The actual investing part is really easy, but often people have questions such as how much risk should I really be taking, or do I have enough money saved up for retirement, or questions about tax reduction strategies for heirs, etc. And so they seek out professional help. But the number one critical mistake that investors make is when they fail to go to a fee-only fiduciary advisor and on a one-time or one-task basis. Most investors don't even know what a fiduciary is. They don't know the difference between a fee-based and a fee-only advisor. They don't understand how their financial future is greatly impacted when they make the mistake of going to a full-service brokerage firm or going to an advisor who has various certifications but is not a fiduciary, and more importantly, is not a fee-only fiduciary. Now, the difference is legal, and if you select the right advisor, then at least the law protects you from the conflict of interest of being sold inferior, more expensive, long-term financial products like annuities, actively managed mutual funds, non-traded REITs, life settlement investments, promissory notes, private equity, trust deed investments, etc. But if you select an advisor who legally works for you and your best interests, you should be advised to invest in simple index funds. But the problem is that about 85% of advisors in the U.S. are non-fiduciaries. That means that legally they do not actually work for you and your best interests. Legally they work for themselves or their company. They're nothing more than salesmen. And the law, which is called the suitability standard, allows them to select investment products for you that pay themselves the highest commissions, but are really expensive for you and lock your money up for many, many years under threat of exit penalties. I'm talking about, of course, products like annuities, actively managed mutual funds, etc. But index funds consistently perform better and are incredibly cheap, but these non-fiduciaries don't tell you to put your money in index funds because the companies that offer index funds, like Vanguard, don't pay commissions. And think about it this way. When you go to a full-service brokerage firm or some independent advisor who doesn't directly charge you anything to help you plan and invest, how do you think they stay in business? Why are they doing this for free? The answer is that you are indirectly paying them, and paying them dearly, when you go along with the expensive products that they are recommending for you. And I know that some people say, oh, no, my advisor, he always sells me no-load mutual funds. And I tell them, you have been duped, because one way or another, the company that offers no-load mutual funds is going to recoup the nice commission that they paid to your advisor. If there isn't a front-end load that was subtracted from the share price when you bought in, then they simply have high ongoing fees of perhaps 1% per year, and most of that goes to Mr. Broker, and it comes out of your investment. And the reason a no-load mutual fund has an early surrender penalty is because once they pay your advisor, they can't take back the commission that they paid him. So they need that perhaps 5-year period to siphon off of your investment with high management fees. So the number one mistake you can make is to go to a non-fiduciary broker advisor, insurance salesman, bank employee, or whatever his title may be. Again, titles and certifications mean nothing when trying to determine if they have fiduciary duty to you. The next mistake that investors make is they go to a fiduciary, but they go to a fee-based fiduciary advisor. I call these guys the loophole advisors because while they have fiduciary duty to you to select products that are best for you, they are still allowed to earn commissions. So they charge you, and they can still turn around and sell you commission-paying products. That's a problem. And I constantly hear stories about these fee-based fiduciary advisors selling annuities to their clients. It should be illegal, but unfortunately it's not. You are not protected. The only way to stamp out this conflict of interest is to go to a fee-only fiduciary advisor, because fee only means that legally their only compensation can come from you only, and no other source. And by the way, a verbal agreement does not cut it. Your advisor must agree to being a fee-only fiduciary in writing, and a legitimate advisor will provide you with copies of both parts of what's known as a Form ADV, and he will provide you with a written disclosure of exactly how he will or may be compensated for his services, and a list of any potential conflicts of interest. Do not work with any advisor who does not provide you with these critical documents. Also, I believe it's important to hire your advisor on a one-time or one-task basis. Otherwise, you're constantly paying them to simply rebalance your portfolio so that you maintain your stock-bond allocation ratio, which anybody can do. And an advisor acts as your behavioral coach to talk you out of doing stupid things like selling low. For example, if the stock market crashes, a lot of stupid investors panic and want to sell off all their stock ETFs. But do you really need to pay an advisor 1 or 2% per year to hold your hand to do that? I say no. By the way, a lot of people have complete misconceptions about what an advisor does, and this is actually probably the number 2 costly mistake that investors make. For example, a legitimate advisor does not attempt to beat the market, does not attempt to buy low and sell high. A legitimate advisor also should not attempt to anticipate the next market crash by selling off all your investments and getting into cash. If the stock market has crashed 10%, 20%, or 30%, or 40%, a legitimate advisor is not advising you to sell in advance of a further decline that he thinks is about to occur. This is not what an advisor does or should do. Anyone who says that they will help you do this is selling snake oil. So if you are seeking an advisor who has a great track record or who has helped his clients beat the indexes by X% over the last 10 years, you are misinformed and you are making an expensive mistake. And I explain why in greater detail in my video, How to Invest Your Money. But so the mistake that investors make is they think that it's necessary to pay some advisor to constantly keep an eye on their investments and hold their hand. The only thing you should be doing is occasionally rebalancing if necessary, which any third grader can do. Just maintain your bond stock ETF ratio. Now, all the talk about fiduciary standard versus suitability standard, fee only versus fee based, all of this is just a legal line of defense. It's a powerful one, but sometimes, well, you need to be aware that there's ruthless advisors out there who may be willing to risk being fined, banned by the industry, or even risk jail time. So you need to make sure they are recommending index funds, not annuities, not actively managed mutual funds, not private equity, etc., and do your own trading on your own through a deep discount brokerage firm such as E-Trade, Ameritrade, or Scottrade, and make sure your advisor's name is not listed on any of your statements. For example, having an advisor's name listed as the broker or agent of record on one of your mutual fund statements, this may indicate that they earned a commission by pushing that product to you. Also, certifications say nothing about whether an advisor is a fiduciary or not, or whether they may make biased recommendations. And I often come across people who got tricked into putting their trust in an advisor simply because they had a bunch of certifications like certified financial planner, and then they got sold high commission-based products like annuities. Also, one of the stupidest arguments I've heard is, my advisor, he's just trying to earn a living. I don't mind paying him an extra 1% per year for actively managed mutual funds. But if you're subtracting 1% per year from your investments, do you know how much this compounds over 10 years, 20 years, or 30 years? Or if you were sold an annuity and you're missing out on 3 or 4% per year, do you know how much that compounds over time? And finally, YouTube is full of non-fiduciary advisors who are skilled at spreading disinformation. For example, they'll say in comments, an asset manager probably costs you just as much as a commission-based advisor like me. But what they're doing is presenting a false choice argument. In reality, both asset managers and commission-based advisors are bad choices, with the commission-based advisor being the worst of the two evils. But fortunately, these aren't the only choices at your disposal, and that's why an investor who can't figure out how to do it themselves should hire a fee-only registered investment advisor on a one-time or one-task basis. Don't pay an asset manager to constantly manage your money and bill you constantly.